Hello, everyone, and welcome to our Financial Transactions and Transfer Pricing podcast. During this podcast, we have informal discussion with specialists of the PwC TP network on recent developments. And I'm pleased to welcome our guest of today. That's Tanya Kaiser from Germany, Andy Payton from Canada, and Harold Mystery from Australia. And I'm David Odur from Belgium. Today, we will have an interesting discussion on new initiatives in these countries and on what tax authorities are focusing on. And of course, it's relevant if you have transactions with these three countries, but the relevance is much broader than that because a lot of these themes seem to be coming back in other countries. So, Tanya, we'll start with you. The last 2 years, we have been discussing on this draft legislation in Germany, and from time to time, there was a new draft with each time something completely different in it. But now, finally, it is there. We have final legislation in Germany. Can you give a high-level overview of what's in there?
Yes, sure. Thanks, David. So you're absolutely right. I guess for many years, there have been various attempts by the German legislature to pass some legislation to focus on financial transactions in Germany. Now, finally, the wait is over and we have final legislation that I'm happy to provide some insights on. So on a high level, the legislation contains two parts. One is to set requirements for interest deductions on intercompany loans to Germany. And the second part is how to remunerate certain treasury activities. So these regulations are effective FY24, which means that loans that were entered into in the past are also affected if they result in interest payments made in 24 or in future years.
Okay, so it's applicable today, but even for loans that have been implemented like 5 years ago, but still going on. Okay, let's focus on the first item. So it's intercompany loans into Germany, so inbound into Germany. There's some more specific guidance on the TP requirements to respect. Can you develop that a bit?
Sure. So there are, in essence, 3 tests that all need to be fulfilled in order to get the desired tax deduction on the interest in Germany. So test number 1 is that the loan needs to be commercially necessary and used for the company's business. Now, this test is designed to prevent that loans are simply being made to create interest deduction when there is no commercial use for them. The second test is a debt capacity test, which means that the German borrower needs to demonstrate that it expects to be able to service the debt from the beginning. And the third test is an interesting one because that is the only one that actually looks at the interest rate itself. And it includes that a kind of default position that the group rating should generally be the guiding principle to set the interest rate. And the reasoning for that is that, according to the German tax authorities, the group rating is seen as a simple and often available way to understand the credit profile of the borrower. And there was also some criticism being expressed about rating analysis that are solely performed for transfer pricing purposes. Now, this last test around the interest rate test and the group test also includes an escape option. So it is possible to demonstrate that a rate that is not the group rating but derived from the group rating should be applicable instead.
Okay. How likely is that you can apply this escape? Is it easy? Is it difficult?
That is a very valid and yet very difficult question, David. So right now, unfortunately, there's no guidance yet on what criteria will be considered as relevant or even sufficient to demonstrate that a deviation from the group rating or even the standalone rating should be applicable. But we shouldn't forget that the OECD also provides some useful commentary on that point, which should be relevant in our view because the OECD guidelines are also binding on the German tax authorities because the whole OECD guidelines are part of administrative guidance in Germany. Now, when we look at the OECD for more insights on that point, I guess in a nutshell, we have to say that it depends on the fact pattern on how we can demonstrate the deviation from the group rating. So aspects such as the relevance of the German borrower to the group overall. So There are, I guess, also in our view, circumstances where the group rating does not provide an arm's length answer. And I'm an optimistic person, so absent any other guidance, I would take the view that it should be possible, but it is a bit unfortunate that the German legislature is kind of defining an extreme position according to the OECD as a starting point, and is forcing taxpayers to fight the uphill battle and to document the reliance on the escape rather than starting without any preconditions on what the starting point for the analysis should be.
It smells a bit like reverse of the burden of proof. And of course, if you have low into Germany, it's group rating, except you can demonstrate the opposite. But you have also the lender's perspective. If you just say it's group rating without any analysis, they will not like it either. So you have to do the analysis anyway. So you mentioned there are two parts in the new legislation. It's what you discussed about the group rating and debt capacity. And the second one was on remunerating treasury activities. Can you explain what are these treasury activities and what type of remuneration is expected?
Yeah, so firstly, around the definition of what those treasury activities should cover, the legislation mentions aspects like liquidity management, financial risk management, currency risk management, and activities such as financing or intermediation and on-lending even of funds within the group of companies. So I suppose you could view that as a rather broad definition of what those treasury activities are covering. Now, again, the German legislation defines kind of a starting assumption that those activities should be regarded as services with a low functional and risk profile. And furthermore, in the explanatory memorandum to the legislation, we see there are some statements being made that those activities should generally be remunerated with a cost-plus method, and the financing cost not being part of the cost base. Now, I know that I'm taking the risk of repeating myself, but there's again, this position can be rebutted and proven otherwise if it can be demonstrated that the functions performed are not low risk and do not involve low functionality and should hence be compensated differently. In terms of application, I suppose one area of application could be cash pools and cash pool leaders. Where I suppose the concept of a cost plus can give rise to some quite complex operational questions on how to actually implement that. A more heavily debated application is on the wording of the legislation that also mentions the on-lending of funds and whether this could kind of introduce almost another kind of test on interest rates coming into Germany if they are resulting in high margins at the level of the intercompany lender.
Yeah, it sounds a bit like the Dutch. They have also some specific rules on lending activities with cost plus or more risk-taking activity. It's a bit the same, and it's interesting. So this covers cash pools, but might be broader than cash pools. If you look to the OECD guides in Chapter 10, they also assume that, generally speaking, cash pool leader is an agency function like small spread cost plus, and by exception, it's rather a risk-taking function. My experience is if you look to the functional profile, most cash pools are risk-taking functions. So it's also here we might have a difference between what tax authorities expect to see generally and what exists in practice. Good. Let's go to Australia. Here in the past, we're also invited a couple of times and you discussed some proposed developments. Do we have some final developments? Are there some final rules that have been enacted?
Thanks, David. Yes, so I think in the past we've discussed briefly the proposed thin capitalisation measures or the new thin capitalisation rules in Australia, which have now passed both houses of parliament earlier this year. And those rules will be applicable for debt deductions for most taxpayers in their current income year. So they apply to income years commencing after 1 July 2023. Broadly speaking, the rules sort of have a default test that aligns to a 30% tax EBITDA test, which is commonly seen globally and aligns to OECD recommendations. That test also has a 15-year carry forward period. There's also two alternative tests included in the legislation, a group ratio test and a third-party debt test. I will note those two tests are quite narrow in their application and will require very careful analysis of any third-party debt arrangements that Australian taxpayers have in place, or where you're seeking to rely on the group ratio test, it's likely you will require input and data at a group level, which may not be readily available to consider potential applicability under those tests. So I guess the expectation and the way the rules appear to have been designed is really such that most Australian taxpayers will default to the 30% test going forward.
Okay, so it's basically application of OECD BEPS Section 4, which you have in the European Union, you have in US, and I think Andy will likely confirm you have it also in Canada. However, you have this group ratio test, so it might be difficult to apply, but my experience that not a lot of countries have opted for this group ratio test, which was an option in the OECD guidance. So besides the 30% EBITDA, are there some other rules that have been enacted?
Yeah, David. So I do think the measures were designed to try and bring Australia's rules closer to the OECD recommendations and what we're seeing globally. But there are some nuances, and in particular, two measures that will require careful consideration going forward. So the first is broadly termed the debt deduction creation rules, and those rules will apply for income years commencing from 1 July 2024. So there's a 1-year deferral for these specific provisions. But essentially, these rules will operate to potentially deny deductions for related party debt into Australia, where the proceeds from that debt are used for certain specified purposes relating to transactions with related parties. So some broad examples where related party debt is being used to fund the purchase of certain assets from related parties, or being used to fund the payment of dividends or returns of capital to related parties, or even common transactions such as the payment of royalties to a related party, they may fall within the scope of these rules and result in a complete denial of those deductions. So it's something that will need to be monitored carefully where you've got related party financing into Australia. The other aspect is historically Australia's transfer pricing rules had a sort of special provision that maintained or protected the operation of the thin capitalisation rules and mandated the sort of interaction between those rules and the transfer pricing rules. The new measures essentially repeal that special rule and will now require, similar to what Tanya was mentioning from a German perspective, that where you have related party debt into Australia, taxpayers will need to consider under the transfer pricing rules the arm's length quantum of any related party debt, as well as the arm's length interest rate.
Okay, so to echo the two rules, so the first one is pure anti-abuse measure, so it's no transfer pricing. If you put debt into an Australian entity that is used for dividend payments and the like, interest is not tax deductible. You have similar rules in other countries, but typically have a carve-out option that you can demonstrate if it's a bona fide transaction, you can still deduct the interest, which appears not to be the case in Australia.
No.
Okay. Yeah, and then the debt capacity. So you started with saying you now have the 30% EBITDA rule, like in other countries, like in Germany, but on top, the tax authorities explicitly mentioned that you should also have an arm's length debt capacity. And yeah, you should, of course, respect both rules at the same time. In practice, if you have to apply these rules, and especially the debt capacity and the like, how to handle this? On what should we focus?
I guess the first one, David, given these rules are currently applicable and obviously represent a pretty significant change for Australian taxpayers, is really trying to forecast and model out the outcomes under the tests in the legislation. And the starting point generally is considering the position under the 30% EBITDA test, which is obviously a complex exercise given the 15-year carried forward period, and trying to get any sort of clarity or certainty around what your position and ability to utilize any carried forward denied deductions might be if you're sort of finding challenges under the 30% EBITDA test. The other key focus, and something that will likely represent a pretty significant change for Australian taxpayers with related party debt, is the new rules will, once the sort of debt deduction creation rules come into play, require a much more granular tracing of the use of funds, which is likely not something that a lot of treasury functions would have focused on in the past. I think generally they just look at a pool of cash as cash and don't necessarily distinguish the source of those funds. And so it's likely that you will need to start thinking through going forward how you clearly trace and support and evidence the use of any related party financing. And I guess the last piece, going to your point around supporting the arm's length quantum or debt capacity analysis, I think that's a pretty well understood process in a number of jurisdictions globally, and there's obviously guidance in the OECD guidelines around how that exercise should be conducted. But if I reflect from an Australian perspective on what might be helpful to start thinking through, particularly given the approach we've seen the ATO take in relation to interest rate pricing and their focus on a group cost of funds approach, as well as the outcome of recent case law in terms of supporting that arm's length quantum, I think really trying to understand group level data points around the level of debt or group external debt arrangements and the commercial rationale of any debt coming into Australia will be really important and probative in supporting that quantum from an Australian perspective. The last point I will note is that the ATO is currently consulting publicly on focus areas for future public guidance in relation to its interpretation of the thin capitalisation rules. It's very uncertain when that guidance will be released, and for example, for 31 July 2024 year ends, it's quite unlikely that we'll see anything before their financial years close. But the ATO has publicly sort of come out this week, I believe, saying that their initial high priority areas for guidance will be restructures, key concepts under the third party debt test, and helpfully in the context of this discussion in relation to related party financing, the interaction of the transfer pricing and thin capitalisation rules.
Okay. What's for me interesting is this granular tracing of funds, so external and internal funds. I think there's some cases where there's a close or loose link between external funds and internal funds, but sometimes how Treasury is organized, there's simply no link whatsoever. That's the strength of working in a multinational group, so that might be a challenge in certain cases. The nice thing about this podcast is that we can move 10,000 miles in a split second, so we go from Australia to Canada. And if I think about intercompany funding with Canada, I think, we have transfer pricing rules, and on top of that, we have a lot of other rules, tax rules that we have to respect. If you want to include a Canadian entity in a cash pooling, we have also all these rules that we should respect. So Canada seems a country with a lot of rules besides the arm's length rule. Can you give us an overview of the various type of rules we should think of when having funding into Canada?
How long do you have, David? So I think two things are going to be true here. One is this might be part one of a two-part discussion on, intercompany financing in Canada. And I think the second part is that I'm probably going to say some of the same things we've already discussed, right? So I think there are some kind of commonalities that you start to hear. But broadly speaking, if I ignore transfer pricing for a second and think about the broader tax rules, there's really three main rules that will kind of limit interest deductibility. One is that general provision on the ability to deduct interest. We'll talk about the purpose of the debt. And then we have our standard and long-standing thin cap test. So again, limiting the debt on an intercompany basis to the 1.5 times the equity. The part that's new, again, consistent with what Tanya and Haral discussed, is something that's consistent with Action 4. So this limitation to 30% of tax EBITDA. Now, that's not quite enacted yet. We'd expect the current draft to be final, but it's not quite there. And so when you take a step back, that's quite a lot of limitations on, your interest deductibility, having a purpose, the debt side of things, the interest side of things. But you layer on top of that transfer pricing, and transfer pricing actually comes first on that list. So any adjustments that are applied, the transfer pricing adjustments come first. The question is, what does that really mean in practice? So if you take a step back and think about what we do historically, we would have said our transfer pricing work should focus on the arm's length interest rate, and the debt side will be covered by our thin cap legislation. But now, given that our transfer pricing adjustments come first, there's really a focus on, is that interest expense arm's length? And that's meaning that we have to turn our attention both to the interest rate, and to the debt amount from a transfer pricing perspective, and that's a bit of a change. So there's lots to think about, and what you'd find, David, is that transfer pricing analysis is really performed in parallel to the kind of broader tax analysis, modelling out the thin cap position and what we call the IFO rules, which is our kind of 30% of tax EBITDA test.
Okay, so you mentioned it's first the transfer pricing test, so debt capacity, and then the other test, which might be a good thing for taxpayers, because if you reassess based on the transfer pricing test, normally you can apply for a map with the other country. If it's your thin capitalization or 30% EBITDA test, that's typically an internal anti-abuse rule. You cannot apply for a map to avoid the double taxation.
I think it's slightly more complex in Canada, unfortunately, where what we're really saying here is we as transfer pricing practitioners might do some work to say, okay, we believe that the debt amount and the interest rate are arm's length, and therefore the interest expense is arm's length. But these other rules might actually bite and actually restrict the interest that can be deducted, even though we've said it's arm's length. Mm-hmm. So it's a very kind of complicated maze that we're going to have to find our way through.
Yeah. So you confirm the rules in Canada are quite complex, and the interaction of all those rules. So these are the rules. But recently, the Canadian authorities also issued a consultation document. So that's not law. It's a document with some ideas they consider or they might consider. Can you provide the highlights of the documents?
Yes. And again, taking that step back, the transfer pricing legislation in Canada has been around for a number of years and predates some of the recent OECD guidance. And so I think the consultation document is a reflection of that. So it's seeking to align our legislation with some of the language in the OECD guidance, and at the same time looking to apply some of those potentially simplifying measures to taxpayers. So do we need to have benchmarking for distributors and those sorts of things? Within those simplifying measures, or at least proposals, is one that refers to intercompany financing. And again, I think what I will kind of explain here is broadly consistent with what I believe you discussed with Erin in New Zealand on the last podcast. And in fact, New Zealand is directly referenced in the consultation document. Broadly speaking, the proposal, at least the proposal for discussion, is to limit the terms of intragroup loans to 5 years, to use a credit rating of the group, to remove subordination quote-unquote features and embedded options. So greatly simplify intercompany financing. The view from finance is that is of a benefit to taxpayers and a benefit to CRA in terms of they will have to do less complex work in reviewing intercompany financing. So again, we've gone through providing a response to the consultation document, and we await additional clarity and guidance, but nothing as of yet. And this consultation document was issued in June 2023, so we're almost at that 1 year anniversary.
Okay, so it's unsure whether that consultation document will actually be finalized one day, and it will be based on the same principles. But it's even a very interesting document for me because it demonstrates the thinking process of tax authorities and their frustration. They want simplifying measures, so they also refer to the group's credit rating as a simplification measure, or loans 5 years, no subordination, options and the like. So keep it simple. But the nice thing I heard that you were saying it works two ways. Also, the taxpayer could rely on those, according to those ideas, which it's not the case in Germany. It's something that tax authorities can apply, but not taxpayers.
Yeah, the point that finance is making is that this might mean that taxpayers don't need to do as much work to prepare transfer pricing documentation, etc. But that's finance's words, not necessarily the words of the tax-paying community.
Yeah. On the one hand, you see controversy in the case law a bit all around the world, where they really focus on the all terms and conditions should fully reflect all the circumstances of the transaction on subordination. So they really push, or they make reassessments based on very specific facts. On the same time, they consider all these simplification measures where you should not make all these type of complicated analysis. So interesting. But let's continue on the controversy. Back to Germany. The German tax authorities are quite active when it comes to tax audits. I know some they can take years and years. With the new law enacted, do you expect some changes in the transfer pricing audits?
Yes, so David, as you already said, there's already high audit activity in Germany. We see high audit activity also focused on specific industries where we've historically seen a lot of loans coming into Germany. So those industries that are likely to have those big financing structures are very often being reviewed. What we've seen in latest years already is a shifting focus from reviewing the interest rate only to capital structures. And there have been various attempts of tax auditors to challenge the capital structure and the debt amount as being too high. But I guess in the past there wasn't a lot of clarity, and the obstacles to recharacterize debt into equity were quite high. So usually at the end, kind of the discussion kind of then went back and evolved around the interest rate as such. Now, someone could say that with the formal introduction of the debt capacity test, there may be a little bit more clarity that as soon as you are not able to demonstrate that you're able to service the debt, then you have a problem from that perspective. But I suppose because the legislation is so vague on how exactly this test should be performed, there are some open points where, frankly, I hope that an arm's length interpretation will prevail on aspects such as, well, what about the repayment structure? So it is apparently clear that it's not only the interest, but also repayment of principal that should be considered. But how does that apply in case the loan is used to invest in a long-term asset, for example? Now, second example is because the debt capacity analysis is forward-looking, what happens if the forecasts that you base your analysis on are not met? How will the tax authorities be able to use hindsight in order to challenge you retroactively? Well, and last but not least, do we now have to do like another form of benchmarking of the debt service cover ratio? Or how exactly, how much cash flow do you need to demonstrate in order to substantiate the debt capacity test? So I guess there isn't a lot of clarity on those points yet. But I am definitely expecting that the tax audits will focus on those aspects in particular before even looking into the good old interest rate analysis.
Okay, so let's meet in 3 years when you have the first experience on the field. Back to Canada. Canadian tax authorities are quite active, but also I consider as quite sophisticated. What are you seeing today as trends?
Yeah, so the CRA continues to audit financial transactions. I think that's certainly the case. I don't know if I could pick out any specific trends, but one thing that we do see is, I think, a level of consistency in the approach that CRA takes. So there's also being a high level of learning within CRA, which I think is good. And as you mentioned, David, there's a couple of court cases and judgments relating to financial transactions, and I think generally speaking, certainly at certain levels of CRA, they have practitioners who are very well trained, very capable. I think if you were to look for one potential trend, it would be that they are looking at transactions more holistically. So we've gone beyond, focus on a credit rating or interest rate benchmarking. I think they are still important. You will still see discussions on those topics, but there's a lot more focus on, what were the options realistically available? Is there a commercial requirement, for this debt? Would you actually go to a bank and try and borrow this money under these terms and conditions? What's happened in your business, and have you changed your financing to right size? So, I think I mentioned before that in my own personal experience, we've seen CRA be very diligent looking at, a range of agreements that related to intercompany debt used for asset acquisitions. And certainly picking up on some of the guidance in Chapter 10 of the OECD guidelines. So, still very active, and I think still, looking at what we consider to be core to our work, but starting to branch out into, those more kind of business type decisions. The one other point I would make is that it's really important that taxpayers consider what should be in their transfer pricing documentation. So those points I made around the commerciality, the reasons for the decision, the options realistically available, they should be in that document so that it meets our reasonable effort standards. And meeting that reasonable effort standard is what's required to avoid transfer pricing penalties applying. And so we do see in the financial transaction space that where there are audits, there are quite often penalties if there's an adjustment.
That's basically because taxpayers tend to focus on documentation on their goods and services and forget about the financial transactions and so forth.
Yeah.
Yeah. Okay. Back to Australia. You mentioned there's some case law in Australia that's important when you consider your capital structure of your Australian subsidiary. Can you provide some insights on what to consider?
Yeah, sure. Thanks, David. So you're right. There has been a number of recent cases which have considered intercompany financing arrangements that have been heard on appeal recently in Australia. And those cases have both been considering Australia's historic transfer pricing legislation, as well as some cases on Australia's general anti-avoidance provisions and how they apply to the intercompany financing arrangements in question. Each of those cases is very fact specific and I guess the outcome influenced by the evidence presented to the court. But if I step back and some of the key takeaways that will be relevant in thinking through your capital structure into Australia and how you support that from the judgments released. Firstly, in approaching, I guess, the question of using OECD terminology, the options realistically available, or as the court sort of put it, the hypothetical alternative in applying the transfer pricing rules to determine what independent parties would have done at the time, that the courts held that the focus really needs to be on evidence of the terms and conditions that would be entered into by independent parties at the time of the transaction. So really held that you can't rely on hindsight, and the focus should really be on contemporaneous evidence at the time, as well as in sort of supporting your pricing on intercompany debt. You can't deviate too far away from the arrangements as actually entered into. So, for example, they didn't find as probative broader debt capital market observations, which weren't closely aligned to the actual terms and conditions of the debt arrangement being considered in the case. The other key point and this is something that's been a consistent theme throughout a number of cases over time, is the courts have reaffirmed that implicit support or the potential for a parental guarantee, so similar to some of the themes that Andy and Tanya were mentioning, is something that will be a relevant consideration for any analysis of related party financing. And so while Australia's transfer pricing rules or regulations don't have a specific requirement to consider the group rating or the group cost of funding, it does highlight that will be a relevant consideration, and that's consistent with the approach the ATO has been taking for a long period in reviews and audits. The last piece, and this was more broadly in the context of the general anti-avoidance rules in relation to an intercompany financing arrangement, but I thought is helpful and had some helpful commentary in the decision, was that the courts did find that the mere fact that entering into a debt arrangement, as opposed to, for example, equity, is advantageous from a tax perspective does not necessarily result in the principal purpose test under Australia's general anti-avoidance rules being met. So the courts recognise that there's clear commercial benefit of the flexibility and ability to repatriate cash that's available through debt as opposed to equity, which I think is quite helpful commentary. And the decision's really held that the regard is required to whether objectively and considering the clear commercial advantages and downsides of the alternatives available, whether there is a principal purpose of tax avoidance. And I guess in coming to that conclusion and the reasoning that the court outlined in its judgment really focused quite heavily on the broader group funding arrangements and the specific circumstances of the related party debt that was in question. So in that case, an acquisition. So it goes to some of the themes that we've been discussing on this podcast, really around being able to substantiate the commercial purpose and rationale for any intercompany debt arrangements, as well as trying to collect that evidence in a contemporaneous manner at the time of entering into your related party financing.
So, yeah, an interesting interplay between transfer pricing and the GARs, the general anti-abuse provisions. Also, you notice that you mentioned that the ATO says that you should consider the cost of funding, or it's a relevant consideration. So it's not something you should do, but they're kind of pushing you towards that, and you could do different, but it might be an uphill battle.
Yeah, I think that's right, and that's been a long-standing view, David. I think they released guidance in 2017 and have been consistently applying it since in reviews and audits, pushing towards that a risk assessment approach that is based off the group cost of funds. And we have seen that actually there has been a bit of shift in taxpayer behaviour in light of that guidance and how the ATO has pushed that sort of risk assessment approach.
Yeah, so once again, it seems like a simplification measure, at least for the tax authorities, but then it's more difficult for taxpayers. It's quite complex. If you look to the case law, transfer pricing rules, anti-abuse rules, if I give you 30 seconds, can you give a recommendation how to have a solid setup?
I think it's similar to the discussions we've had across the various jurisdictions. It's really trying to understand and focus on the evidence that's available at the time of entering into a debt arrangement will be really important in supporting your intercompany financing going forward from an Australian perspective, and I think globally. So understanding alternative financing options that were actually sought or available at the time of a related party financing instrument being implemented, understanding the broader group policies and any external debt arrangements at a group level that may provide helpful comparable data points or commercial context, and coupling that with, I guess, the traditional analyses we've done, focusing on industry practices and available comparable data, but really being able to paint that commercial story with contemporaneous evidence will be the most probative in being able to support your related party financing going forward.
Okay, great, thanks. We're almost at the end of the podcast, and I said there are some commonalities in all these discussions, so the relevance is much broader than the three countries we are discussing. My key takeaways are, first, the quantum of debt. It's already in the transfer pricing guidelines, so it's not something new, but the mere fact that this is explicitly mentioned and further developed in documents of the tax authorities demonstrate that this is becoming increasingly important. Second one is the credit rating. So it's a discussion that started like 25 years ago. I thought 15 years ago it was more or less tested and settled, and it comes back. It comes back again. Group rating, but then you can go against the group rating. But tax authorities, they like it for inbound loans, not for outbound loans. So you might have noticed it, but Tanya was talking about inbound loans, and when we discuss about applying the group credit ratings for inbound loans, so to lower the interest rate, not for outbound loans. And then all these simplification measures, or these measures that might simplify the life of tax authorities at least. And for me, I'm struggling because if you look to controversy in a lot of countries about commercial purpose, options realistically available, you should do a really deep dive in all the circumstances surrounding a transaction to have a decent analysis. But at the same time, they're kind of reflecting on or pushing on very simplified, overly simplified approach where you disregard all these specific facts and circumstances. So there I'm a bit puzzled where tax authorities and legislators will go to in the future. With this, we are at the end. So I would like to thank the three co-presenters and the listeners for tuning in, and hope to see you soon. Thank you.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.